I want to talk about your retirement savings. More specifically, I want to talk about the single greatest threat to them. And it isn't what you think. It's not a looming recession. It's not the Federal Reserve raising interest rates. And it's not even picking a few bad stocks. The greatest danger to your financial future, the one force that has the power to wipe out years of hard-earned savings, is looking at you in the mirror every morning. It's you. And the worst part is you're being encouraged every single day to indulge in the very behavior that will destroy your wealth. Now, that might sound harsh, but after more than 80 years of watching markets, I can tell you it's the simple truth. Most people get into this game thinking it's about being smart, about being active, about outwitting the other fellow. They think investing is a flurry of activity, buying this, selling that, reacting to the latest headline from Washington or a rumor from Wall Street. They believe that because you can trade every second of the day, you should. That single belief is financial poison. Let me ask you a question. If you owned a productive farm, would you sell it tomorrow because the weather forecast for next week looked a little cloudy? If you owned a profitable apartment building, would you put it on the market because you heard a rumor that two of your tenants might move out next year? Of course not. You would look at the long-term earning power of the asset. You would focus on the bushels per acre or the monthly rent checks. Yet when it comes to stocks, which are nothing more than partial ownership in a business, people lose their minds. They let the daily chatter and the manic mood swings of the market dictate their actions. My great teacher, Ben Graham, knew this better than anyone. To explain it, he created a parable about a business partner of yours named Mr. Market. Imagine you own a piece of a private business with Mr. Market. Every day, without fail, he shows up at your door and shouts a price at which he's willing to either buy your share or sell you his. The thing about Mr. Market is that he's a manic depressive. Some days he's euphoric. He sees nothing but a glorious future for your business and offers you a ridiculously high price. Other days he's in the depths of despair. He's convinced the world is ending and is willing to sell you his share for pennies on the dollar. The rest of the time, he's more or less sane, offering a price that seems reasonable. Now, this fellow has a very useful characteristic. He doesn't mind being ignored. If you don't like his price, he'll be back tomorrow with a new one. The choice to act is entirely yours. Now, how should you behave with such a partner? If you're a sensible business person, you'd ignore him most days. You'd go about your business, tending to your farm. When your business partner, Mr. Market, feels discouraged and offers to sell his share for less than it's truly worth, it could be a good opportunity to buy. And when he's feeling very optimistic and wants to buy your share for more than its actual value, it might make sense to sell. However, many investors respond differently. Instead of viewing Mr. Market as a helpful reference, they tend to mirror his emotions. When he's enthusiastic, they become eager buyers. When he's anxious, they become fearful sellers. In doing so, they allow market sentiment to influence their financial choices rather than basing decisions on their own understanding of their business's true worth. You have turned a fundamental advantage, the liquidity of the stock market, into a crippling disadvantage. The fact that You can get a quote on your business every second, makes you feel like you have to do something about it. Nothing is further from the truth. The stock market is there to serve you, not to instruct you. This constant need for action is fueled by a whole industry of people who get paid for activity. Your broker wants you to trade. The financial news channel wants you to watch, convinced that every tick of the Dow is a momentous event. The so-called experts, the economists, make a living by making predictions. Charlie Munger, my partner for over 60 years, and I have been in business for well over half a century. What you need isn't a crystal ball, it's the right framework for thinking about what you own. You are not buying a stock ticker, you're buying a piece of a business. Your success will not be determined by what happens to the stock market in the next quarter or the next year, but by what happens to the underlying business over the next 10 or 20 years. So how do you protect yourself from the greatest enemy, yourself, and the siren song of Mr. Market? It comes down to a few very simple but not easy principles. And in a moment, I'm going to walk you through the very same framework we use at Berkshire Hathaway. It doesn't require a high IQ or a fancy degree. In fact, a high IQ can sometimes be a liability in this business if it's not paired with the right temperament. What it requires is discipline and the correct orientation. And it starts with a concept I call the circle of competence. Before we get to that, let's address the central illusion that drives so much destructive behavior: the belief that you can and should predict the short-term direction of the market. Let me tell you a story. Back in the 1920s, a fellow named Edgar Lawrence Smith wrote a very important book. He set out to prove that in times of deflation, bonds were a better investment than stocks. Yeah, but as he studied the data, he found the exact opposite was true, even during periods of stable prices. He had the intellectual honesty to admit his original thesis was wrong. He discovered something that seems obvious to us now, but was revolutionary then. A stock is not just a piece of paper that pays a dividend. It's a claim on a business that retains a portion of its earnings and reinvests them. Those retained earnings are what build future earning power. A bond, on the other hand, is a static instrument. Its coupon is fixed. It has no potential to grow its own earning power. Smith's insight was that this reinvestment of earnings gave stocks a powerful compounding advantage over bonds over the long term. This was a very good idea, but as my friend Ben Graham used to say, you can get into more trouble with a good idea than a bad one. Why? Because a good idea works. It worked in the 1920s, and people saw stocks going up. They got excited. They forgot the underlying logic that stocks were attractive at a certain price relative to bonds. They just focused on the part that said stocks go up. They started paying any price for stocks, borrowing money to do it, and a speculative bubble formed that ended in the crash of 1929. They took a sound business principle and turned it into a dangerous mantra. We see the same thing today. You hear people say, there is no alternative, or TINA, meaning you have to buy stocks because interest rates on bonds are so low. Now, as I've written in my annual reports, it is true that stocks are far more attractive than long-term bonds right now. A 30-year Treasury bond might yield you, say, 2%. That's like paying 50 times earnings for a business whose earnings can never go up for 30 years. That's a terrible investment. Compared to that, a cross-section of American businesses selling at 20 times earnings with the ability to grow those earnings looks like a bargain, but that does not mean you should buy stocks at any price. It doesn't mean you should ignore valuation. It doesn't mean you should borrow money you don't have to pile into a rising market. That is the path to ruin. It's the same mistake people made after reading Edgar Lawrence Smith's book. They took a good idea and ran it right off a cliff. The key is to separate the business from its stock price. This brings me to the circle of competence. To invest successfully, you don't need to be an expert on every company, or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. And think of it like this. Ted Williams wrote a book called The Science of Hitting. In it, he had a diagram of the strike zone broken into 77 squares, each the size of a baseball. He knew that if he only swung at pitches in his sweet spot, the high inside part of the plate, he would bat .400. If he had to swing at pitches on the low outside corner, he might only bat .235. His whole strategy was to wait for the right pitch. In investing, you're in what I call a no-called strike game. You can stand at the plate all day, and the pitcher can throw you pitch after pitch. General Motors at 68, General Electric at 115. You don't have to swing at any of them. You can wait there for the one pitch you love, the one you know you can hit out of the park. The only way you can have a strike called on you is if you swing and miss. The problem, of course, is that the crowd is yelling, "Swing, you bum!" Your neighbor just hit a home run on some stock you've never heard of. Your brother-in-law is bragging about his profits. You feel like you have to do something, so you swing at a bad pitch. That is the single biggest mistake an investor can make. Your job is to define your own sweet spot. What businesses can you understand? For me, it's things like insurance or consumer brands like Coca-Cola or See's Candies. I understand their economics. I can have a reasonably high degree of confidence about where they'll be in 10 or 20 years. I don't know where the price of cocoa beans will be next year. I don't understand the latest high-tech invention. So I don't swing at those pitches. They are outside my circle of competence. It's no sin to miss a great opportunity outside one's area of competence, but I have passed on a couple of really big purchases that were served up to me on a platter and that I was fully capable of understanding. For Berkshire's shareholders, myself included, the cost of this thumb-sucking has been huge. When you're looking for businesses to own, you're looking for two things. First, a business you can understand. Second, a business with a durable competitive advantage. I call this a moat. A great business is like a wonderful economic castle. And in a capitalist society, you're going to have all sorts of people trying to attack that castle and take it over. So you want a castle that's protected by a deep, dangerous moat. That moat can be a powerful brand like Coca-Cola. It can be a low-cost advantage like GEICO. It can be a regulatory advantage, but it has to be something that protects the castle's profits from competitors. Your goal is to find a wonderful castle with a durable moat run by able and honest management, and then to buy it at a sensible price. And once you've bought it, your job is to sit. Just sit. Let the management do their work, let the earnings compound, and ignore Mr. Market when he comes screaming at your door with his daily prices. Let me tell you the story of a woman who understood this better than any PhD in finance I've ever met. Her name was Rose Blumkin, or Mrs. B. She came to the United States from Russia in 1917. She couldn't speak a word of English. She had a tag around her neck that said Fort Dodge, Iowa. She eventually made her way to Omaha, and for 20 years she saved money by selling used clothing. By 1937, she had saved $2,500. With that money, she started a furniture store, the Nebraska Furniture Mart. She couldn't read or write. She had no formal education. But she had a very simple business philosophy: sell cheap and tell the truth. She knew she could outwork anyone. She cared deeply about her customers. She built this tiny store with $2,500 into the largest home furnishing store in the doing more business in one location than all of her Omaha competitors combined. I bought the business from her in 1983. I gave her a check for about $55 million, and she gave me her word. We didn't have an audit. We didn't take inventory. Her word was good enough. After she sold the business to me, she kept working. She worked until she was 103 years old. She worked 7 days a week, from opening to close. She was a force of nature. What does this have to do with your retirement savings? Everything. Mrs. B didn't have a stock ticker. She wasn't worried about the Federal Reserve. She wasn't reading analyst reports. She was focused on the one thing she could control: delighting her customer. She built a business with an impregnable moat based on low prices and trust. She took a simple, ordinary business and turned it into an extraordinary operation. She never put another dime of capital into that business after her initial $2,500. The entire $1.5 billion enterprise that exists today was built on retained earnings. That is the power of compounding in a great business. If you had owned a piece of her business, your only job would have been to not sell it. That's it. Let this incredible woman and her family work their magic. The temptation, of course, would have been to sell when someone offered you a big profit, or to panic and sell during a recession. Resisting that temptation is the entire game. So let's bring this back to you and your savings. What is the practical, actionable advice? I'm going to give you the same advice I've given to my own family, and it's what's written in my will. For the vast majority of people, I'd say 99 out of 100, the single best thing you can do is to own a low-cost S&P 500 index fund. When you do that, you are buying a cross-section of American business. You are buying into the compounding machine of these great companies. You are owning a piece of Coca-Cola and Apple and hundreds of others. You are harnessing that American tailwind that has propelled this country forward for over 200 years. This approach requires no genius. It requires no market timing. It requires no expertise in picking individual businesses. Your only job is to buy it consistently over time. Buy it when the market is high, and buy it when the market is low. In fact, if you are a net saver for the rest of your life, you should get down on your knees and pray for the market to go down. You should be happy when prices are low, because it means you're buying your hamburgers, your pieces of American business, at a cheaper price. Many investors get this one wrong. Even though they are going to be net buyers of stocks for many years to come, they are elated when stock prices rise and depressed when they fall. This reaction makes no sense. Only those who will be sellers of equities in the near future should be happy at seeing stocks rise. Prospective purchasers should much prefer sinking prices. The key is to automate it. Have a certain amount taken out of your paycheck every month and put it into that index fund, rain or shine. And then do not look at the statements. Do not listen to the noise. Do not let Mr. Market into your head. If you do that for 20, 30, or 40 years, you will do very well. You will beat the vast majority of professionals who are busy trading in and out, running up commissions, and convincing themselves they can outsmart the market. Now, if you insist on picking your own businesses, you must follow a much stricter set of rules. First, as I said, stay within your circle of competence. If you don't understand it, don't buy it. Second, for any business you consider buying, you should be able to write on a single sheet of paper the reason you are buying the entire company at its current market price. If it's because your broker told you to, or because you saw it on TV, or because the stock has been going up, that is not a good enough reason. You must have a business reason based on your estimate of its future earnings. If you can't write it down, you have no business buying it. Third, you must demand a margin of safety, as Ben Graham taught me. You don't try to buy businesses worth $83 million for $80 million. You leave yourself an enormous margin. When you build a bridge, you insist it can carry 30,000 pounds, but you only drive 10,000-pound trucks across it. The same principle works in investing. You want to buy a business for significantly less than you think it is conservatively worth. This gives you protection against bad luck or your own errors in judgment. And finally, you must have the temperament to withstand the madness of Mr. Market. When you buy a good business at a fair price, you should not be bothered if the stock market closes for the next 5 years. You don't need a daily quote on your farm to validate your well-being. You shouldn't need one for your stocks either. This temperament is the rarest quality in investing, and I have seen all kinds of people with 160 IQs with intense interest in the subject, lots of experience in the investment world, self-destruct. They have a certain amount of natural flow of juices just to be excited about the game. And the trick, of course, is to keep control of those juices. Most people, even smart people, have trouble not getting caught up in the game and thinking, I'll just dance one more dance like Cinderella at 5 minutes till 12. But the trouble is, in the investment world, there are no clocks on the walls. So, to summarize, the biggest threat to your retirement is not the economy, it is your own behavior. Your primary defense is to shift your mindset from that of a stock trader to that of a business owner. For most, the simplest and most effective way to do this is to systematically buy a low-cost S&P 500 index fund and then ignore it. For the few who want to pick their own businesses, you must operate with strict discipline. Stay within your circle of competence, buy with a margin of safety, and most importantly, treat Mr. Market not as a guide, but as an opportunity. In the end, investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. It's a game of temperament. It's about controlling your emotions and avoiding the big mistakes. My whole career can be boiled down to a few good decisions and a lot of patience. You don't need to do extraordinary things to get extraordinary results. You just need to avoid doing the foolish things that most people do. Ignore the noise, buy good businesses, and let the incredible power of American enterprise do the heavy lifting for you over time. Do that, and you'll not only protect your savings, you'll build a secure and prosperous